Hello everyone. Today's class we're going to learn the very last chapter we're going to cover for this subject, chapter number 7. And the other chapters after this one will be just optional, and we won't be covering those chapters after chapter 7 in the final exam. So from chapter 1 to 7, these are the core chapters we're going to test in the final exam. But you are welcome to read through the chapters after chapter 7 and let me know if you have questions about those chapters. So chapter 7 is to talk about the depreciation and income taxes. Actually, I think this chapter is really close to your daily life because you might hear about depreciation already, right? Like if you have a new car, but you used it for 1 year, then the value of the car will be reduced. So the time when you want to sell it to the dealer again, like trading, or if you want to sell it to a second-hand market, the price is not gonna be the initial price, right? Because you have used it, so the parts of the car have been worn out, and there might be scratches on the car's body. So a lot of things sum up, and then in the end, the price of the car is not the initial price anymore. So this type of value decrease, we can call it depreciation. Depreciation is just a term that we used in the accounting or in the economic engineering economy to describe that something's value is decreased during the usage. And income taxes is also very useful. If you can understand this, then you won't be having any problem for you to submit your IRS forms, tax return forms every year. Okay, so and also the depreciation and income taxes are the two more things you need to consider when you build up your cash flow diagrams. So before chapter 7, all the cash flow diagrams, the numbers of cash flows are given, right? And those cash flow numbers, the amount of money, they already covered the initial amount and also the depreciation and income taxes. But in the real life, in your real project, you are gonna be the person to consider the initial price, the depreciation and the income taxes. So how do you, for the initial price, it's easy because it's always proposed by somebody, right? If you want to buy something, the price is tagged. If you want to, spend money to maintain something like yearly expense, it's given by the person who served that maintenance, right? So prices are always given by another body, but the depreciation and income taxes are something else you need to determine every year for your property, for your company. So this chapter is to teach you how to calculate the depreciation and the income taxes, and how are you going to build up the so-called after-tax cash flows. All right, so the first thing, we have another attendance check, number 3, which is due on November 16th at the end of that day. So still there are just 3 or 4 questions. I don't quite remember that, but they're very easy, just multiple choice. And so just go ahead and quickly finish this attendance check. And okay, so the first thing about depreciation is we need to understand the concept of depreciation. Okay, so depreciation is the decrease in value of physical properties. It's a physical property, so something tangible, okay, you can touch. With so physical properties is opposite of the intellectual property. Okay, so when we talk about depreciation, we always talk about the physical properties, not the intellectual properties. With the passage of time and use. Okay, so time and use. Sometimes you use it and it's very easy to understand. If you use it, it's worn out, right? So the price, the value will decrease. But sometimes, although you don't use it, you don't use equipment, you don't use a piece of property, but it still get decreased. The value is still getting decreased just because of the passage of time. Okay, so the longer time it sits there without use, even without use, it still loses its value. Okay, so that's, you need to be careful about time and use. And so here is an example to make sure you understand that. So maybe you've heard this, as soon as you drive off the new car from the dealer's lot. So you buy a new car, so as at a price, and as soon as you drive off that dealer, you've already lost its value. Okay, and you will lose 10% of its value for the first mile you drive. Okay, that's just a common saying by dealers and by car fans. But why do you have this saying? Because of the depreciation. Okay, because you have used it. It's not new. It's not untouched anymore. Okay, and equipment loses value as well. Okay, so if you buy an equipment in your factory for producing something, and so if you use it, it will lose its value. If you just let it sit there unused, it also will lose its value. Okay, and business owners love depreciation. Okay, once you're a business owner, you will understand that, because depreciation is the money taken out from your taxable income. I will say it again. Depreciation is the money amount taken out from your taxable income. So, for example, if you need to pay tax based on your income, right? If the tax is 1,000, and then you can claim that you have your business and the depreciation of the property you own for the business is maybe 100 every year. Okay, so every year you lose the value of the property of the, no matter if it's a building or if it's a factory or if it's a equipment, all the things related to your business. If you claim that the depreciation is 100 every year, then the tax you will pay will be 1,000 minus 100. So it's 900 instead of 1,000. Okay? Which means if you have depreciation, you will pay less tax. And if you have more depreciation, you will pay even less for tax. So business owners, come on, you like it, right? You want to pay less tax. So that's why business owners love depreciation. And they always want to maximize the depreciation of their properties, right? Because the higher depreciation you have, the lower tax you pay for that year. So this one is very important. I want you to just understand this, okay? Pause the video and then rewatch this part to understand why business owners love depreciation and why the higher depreciation the better for business owners. All right. And then tax depreciation is an annual deduction against the income such that the effective time and use on an asset's value can be reflected in a firm's financial statement. See, this is what I said, why business owner loves depreciation, because that's the money taken out from their income, from their taxable income, or from their tax. Okay, so it will reduce how much tax you owe. You owe IRS. So how to calculate exactly how much can be deducted from the tax you owe? That's gonna be a key question, right? So you start to love it. You know, based on depreciation, you're gonna pay less tax. So how much do you claim? How do you calculate that? Okay, so now we need to know different methods to calculate. And to use these methods, we need to understand some basic concepts. First one is cost basis. We write it using B. So capital B is cost basis. This is the initial cost of acquiring an asset plus sales tax, and also plus the cost to make it serviceable. Okay, let's try to interpret this sentence. This is the initial cost, the cost basis. B is the initial cost of acquiring an asset. Think about that. If you are making a wood product, what do? You buy a factory or you rent a factory, right? You have all the utilities and you have electricity and you have the equipment, the saws, right? And the cutting machine, the wood processing machine. Those are the equipments. And all of this is called asset. Okay, so you need to purchase an asset to make your business running. And the purchase price, the initial cost should be the price plus the sales tax. Okay, also you need to plus any cost related to the transportation, the installation, whatever service needed to make all the asset running, to make it run. Okay, so for example, if you buy equipment, your cost basis is not just the price of that equipment. It should be the price of that equipment plus the sales tax of that equipment plus the deliver fee for the sellers of that equipment to transport that equipment to your site, and for them to install that so that the equipment can run. Okay, so it includes the initial price and then the sales tax and also the cost to make it serviceable. This is very important. Okay, not just to think about the price tag. You need to think about how do you make that equipment working, the whole cost. That's your cost basis. All right. Another concept is book value. So book value, we write it as BV. It is the value of asset as shown on the accounting records. Book means your accounting book. Okay, so every year, if you're accountant, every year you're going to audit the asset, and for that year you need to write down the value of that asset. So that value for that year on that accounting book is called book value. So how much the property is worth at different times, that is the book value of that asset or of that property. Okay, which means that value will change. It varies every year because every year you're gonna have a little bit depreciation. So that book value will be decreased a long time. Okay, and it represents amount of money still invested in the property. Okay, So if you claim my book value of this equipment is 1,000, means you're telling the IRS that you are still using 1,000 for owning that equipment. Okay, so that 1,000 is something you need to run the equipment, you need to run the business. So please, IRS, don't tax on that 1,000 because that's needed for the business. That's not my profit. Okay, so it represents the amount of money you are still investing in the property, and it is how much the property value on paper, and this value decreases over time, just like what I said, because every year you have a little bit depreciation. So your book value of that asset or that property will be smaller and smaller and smaller. Okay, and since the BV is different every year, we use the BVK to represent the book value at the end of year K. So you will be asked, like, what is the book value in the first year, at the end of the first year, or what is the book value at the end of the sixth year? So the book value at the end of the first year will be BV1, right? And the book value of at the end of the sixth year will be BV6. Okay, so K is the year you're looking at. And businesses use a set of standard methods to determine how much depreciation occurred during each year. So there are a set of methods we can use. All right, so another thing to understand is not everything can be depreciated. Okay? Not everything. Like what can be depreciated? So here are the things you can depreciate. First, the things are used in business or held to produce income, like equipment, okay? And so, which means, like if you're a business owner, not all of your expenses can be depreciated, okay? So, like the money you invest in your business, okay, it's depreciated, and then like the money you buy the gifts for your kids or you buy the meals for your family, okay, the meals you have not in working days, or the house you live in instead of the house you use for the work, okay, so those things are not depreciated, okay, because they're not directly related to your business. Only the things that are used in business or held to produce income, that are the things that are depreciated. And so that's the first category. The second category of things that are depreciated is the thing that have a determinable useful life, usually longer than 1 year. Okay, so first, if you already know that thing is related to your business and it's to produce income, and the useful life for that thing is longer than 1 year, then you can claim that this thing is depreciated. If it's very short, I mean the useful life is very short, like the gasoline, okay? Or if it's very long, like a piece of land, then those things are not depreciated, okay? For example, you can claim that to run my business, I need to drive that van to deliver things, to deliver materials, but the van will use gasoline, but the gasoline used by that van is not depreciated. You cannot claim that in the accounting book, okay? That's the example for the gasoline. And also the piece of land. If you you purchase a piece of land and you build a factory on it, and you have a factory running to produce wood product, and then only the equipment and maybe the rent of that factory or the construction fee for the factory can be depreciated, but that piece of land is not going to be depreciated because the useful life for that is very long. If it's very long, it stands there almost forever. So it is barely depreciated, right? And the next category is something can wear out or decay or get used up or become obsolete or can lose value from natural causes. Okay. And the opposite side of these things will be like diamonds, golds, because these things are not depreciated. They are not they do not decay. Okay. And they will keep their value for forever, for a long time. And the last category are the things that are not inventory or stock in trade or investment property. So like if you have inventory in your factory and the value of those inventory, like for example your wood products like your furnitures, the finished furnitures sitting in the inventory, um, they are not depreciated because they have value and they can be sold, they can produce value sometime at a later time. So these things are not depreciated. Okay. So you need to understand there are things that can be depreciated, but there are things that are not, and you need to distinguish the two different types of items. So why would a business want their property to depreciate? We just explained this because if you have depreciation, you will pay less income tax. Okay, and let's continue about the concepts. So we have talked about the cost basis, the book value, and the BVK, and then we need to understand the BVK is always the cost basis minus the depreciation deduction in year one and minus the depreciation deduction in year two until the depreciation deduction in year K. Okay, so you need to use the cost basis B to minus all the depreciation deduction during the K years. Then you can have the BVK. That's your book value of that property at the end of the year K. Okay? Or you can say it's the cost basis minus the sum of the depreciation deduction in all the K years. That's the same. Okay? And so BV is different at the end of each year. Can you understand that? Because every year you have a little bit depreciation. And the recovery period N. Recovery period is actually the many years, the amount of years that the thing can be depreciated. Okay, usually you cannot depreciate your property like forever, okay, for too long. Usually you can depreciate it within the useful life of that property, okay, or even less than that useful life, fewer than that useful life, okay. Sometimes the recovery period is given by the government. So you need to know like how many years you can depreciate that. And the market value, we have learned this before. Market value is the market value at the end of year end from the disposal of an asset. Okay, the amount realized if asset were sold on open market. And again, there are another value called salvage value. It's just an estimated trade-in or market value. It's estimated, okay? It's not the real price on an open market. It's just the estimated trading or market value of an asset at the end of its useful life in year end. Okay, so these two are a little bit different. The market value is the real price that you just sell your property on the open market, but the salvage value is just the estimation. And annual depreciation deduction DK, it is the depreciation in year K, okay, or the end of year K. It's written as DK, okay, and the DK star, that's the cumulative depreciation through year K. So DK star is DK from year 1 to year K, the sum of DK from year 1 to year K. So it is D1 plus D2 plus dot 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 plus DK. That's your DK star. It's a cumulative. It's the sum, okay? All right, so I will leave this the content left for the part 2 of this video, okay? So I will give it a pause here.